Hello and welcome to this week's episode of Nucleus Investment Insights. Today's episode is called Will Oil Fuel the Flames of Inflation? Since the outbreak of the conflict in the Middle East, oil prices have surged higher. Today, we'll discuss what impact this might have on inflation. In the short term, it's obvious inflation will be higher. If this continues, workers could demand higher wages and the cost-push inflation spiral will continue. On the other hand, this might be demand destruction and the end of the strong consumer spending cycle post-pandemic, as consumers simply have less to spend due to persistent higher prices. We'll discuss all this and the investment implications in today's show. Just a quick reminder, this podcast is general advice only and is not intended to be specific to your personal situation. If you do want to discuss your personal financial situation and how to improve that, you can book a call with me or one of the advice team at nucleuswealth.com/contact. Today, as always, we have Nucleus Wealth's Chief Investment Officer and co-founder, Damien Klassen. Damo, welcome.
Hey, Sam.
Damo. And today we also have Nucleus Wealth's Chief Strategist and other co-founder, David Llewellyn-Smith. Dave, welcome.
G'day, Sam.
My name's Sam Kerr. I'm the Head of Advice at Nucleus Wealth. We are live every Thursday at 12:30 Australian Eastern Time, so jump onto the Nucleus Wealth YouTube channel and you can ask any questions that come to mind, and we'll do our best to answer them during the show. We're currently offering a free, no-obligation super review, so we'll give your super a health check. We'll give you clarity on the fees you're paying, how you're invested, and the tax-saving strategies on offer. So you can book in via nucleuswealth.com/contact. So that's pretty much the intros out of the way. So Damo, over to you to get the ball rolling.
Yeah, so we'll have a quick look at oil again. So we've obviously been running through some inflation issues for the last couple of years, and I think certainly a narrative which we're pretty comfortable with is that a lot of the inflation was sort of based on a lot of the initial stages of inflation was based on a mix of different factors. Part of it was supply chain restocking. Part of it was the problems with supply chains as well, and and then the extra demand for goods sort of being up a lot of prices, and then those were starting to sort of factor in or were starting to come off, and then the Ukraine war hit, and that sort of took a whole bunch of oil and created a lot of off the market, created a lot of energy problems, and so we ended up in this sort of extended period, and then we started to get through some a lot more in terms of a lot more price rises, a lot more wage rises, particularly in the US, not so much elsewhere, or not so much certainly in Australia. And I guess the question is, as inflation's fading away, is there potential that we're going to see another spike in oil following on from the problems in the Middle East, and what that could mean, and what that might look like in terms of the stocks versus bonds calls, but also within sectors. So with that sort of intro, we're sort of going to look at it from three different angles. One is just the geopolitical angles and what we're sort of looking for on that front. Then we want to look at demand. We want to look at the cost push inflation and see what are the signs that we could see that is actually factoring through. And then finally, having a look at the sort of demand destruction side and sort of try to weigh up the factors in terms of that. But I might start with the geopolitics, and Dave, it's I guess your forte, having run the Diplomat magazine for a number of years. So I want to head over to you to maybe give us a bit of a summary of the situation and what you're seeing.
Sure. So, I might start with a little anecdote. I was describing the situation to my 12-year-old daughter last week when she, suddenly had all of these images of war appearing on her TikTok feed, which is where she gets most of her critical information. And I said, "Well, do you understand the history of Israel and the Holocaust, World War II, and Zionism and what have you?" And she's like, "Yeah." And so she's done a history on that front. And I said, "Well, you realise when Israel was founded and the Zionist policy came to fruition and in an Israeli home state, in the Holy Land, etc., then a lot of Palestinians were displaced. And she said, so who's the good guy in all this? And I said, well, therein lies the problem. Both sides have legitimate arguments, and so it's a sort of perennial fight because both of them are justifiably upset.
Yes.
So
I'll take you one human rights violation, and I'll raise you one.
Well, sadly, that's the way it plays out. But I guess the point I'm making is that this kind of an interminable conflict that's raised its head again. Now, there are some interesting dimensions to it now that we perhaps haven't seen quite so clearly before, and that is that it's more of a proxy war now than it has been for the last few decades. Certainly, Israel has always had strong US backing, but perhaps the Palestinians didn't have quite so much regional support actively from regional states, and so and in fact global states. So to flesh that out, on one side we have Israel and its various liberal state supporters, particularly the US. On the other side, Palestinians are backed, or at least Hamas is backed in some measure by Iran, and Iran is something of a client state to both Russia and China, and so those tendrils reach out from Hamas all the way up into the sort of liberal democratic versus autocratic Cold War 2.0 that we've seen develop over the last few years. So what does that mean? It means that the Hamas atrocities in Israel were pretty much given the green light by Iran, and for the purposes of derailing what Israel and the US were up to in Saudi Arabia and some of the Gulf states. And that is a process of détente, where Saudi Arabia was going to effectively, officially recognise Israel as a legitimate state and establish diplomatic ties, in return for, greater US or deeper US strategic links, possibly a strategic guarantee. And then there was some more stuff proposed on the ground where the PLO, or the former PLO, that's running the West Bank, was going to be promoted as the sort of legitimate leadership of the Palestinians. And that was obviously, all in part directed at Iran, because it was a sort of encirclement of Iran by US allies. And so Hamas has scuttled this entire plan through invading, not invading, but attacking southern Israel and enraging, the sort of Arab man on the street, which has made it nigh impossible for Saudi Arabia to continue with the détente. So that deal has more or less collapsed. And so even early in the piece here, Iran has effectively, in geopolitical terms, already met its objectives in allowing or green lighting, to whatever extent they're involved, Hamas to go ahead. So, obviously this is all horrible for if you live in the Holy Land itself. But in terms of regional escalation, this is probably good news within, the scope of it all being horrible. By which I mean, if Iran's met its objectives of derailing this wider détente between Israel and the Sunni states, then it has no real reason to press the conflict further for its own interests. That assumes a certain amount of rationality on the part of Tehran, which I think is probably fair, even though it is an Islamic state. That's not to say that it doesn't make the same calculations as other states. And at this point, it's, at almost minute zero loss to itself, delivered a huge win in terms of derailing plans that, the plans that were in place to do it some serious harm. So I think that's the key in terms of thinking about whether we get a wider conflict out of this. Is it in Iran's interest to press the case here? And it's probably not. I mean, they've had the big win, and taking it regional will only do them harm at this point. If the US is forced to come in and bomb strategic sites, or their borders are destabilised, etc., by a conflict in Syria and stuff. Now that's I think the key calculation for assessing potential regional conflict. And there is the possibility of more localized expansion. So on that front, obviously, Iran's second proxy, Hezbollah in Lebanon, is an issue for possible escalation. But they've been fairly restrained so far. I mean, you wouldn't describe their rocket attacks into northern Israel as much more than virtue signalling support so far. It certainly hasn't been militarily important. It hasn't really drawn a lot of Israeli forces north. Israel certainly wouldn't want to fight a two-front war, so it's got no real interest in expanding the conflict. China and Russia, I mean, possibly they would like to see the US bogged down, and so they might be interested in a wider conflict, but, I'm not so sure even on that front.
Yeah, and it's hard to see that. I mean, the Israeli armies, whatever, 500,000 people that they've sort of got activated at the moment. It's not as if they're basing overwhelming force that they really need a bunch of US soldiers just to be able to, so like an extra 10,000.
No, they would need boots on the ground, but they probably would deploy a lot of US hardware, which they are doing right now. And so arguably Russia would see upside in this by creating a two-front war for the US. And so it might see an interest in seeing it, a wider conflict. But then again, you'll destabilize Syria, they'd be drawn in there. And so, there are swings and roundabouts in this. And China, is, at the end of the day, I think more just a fence sitter here and, just interested in getting the cheapest possible oil it can from whoever will provide it. So could we see an oil embargo just based on, a contained conflict as a way of, the various dictatorships and totalitarian states, placating the anger on the streets, possibly, maybe an Iran-led oil embargo, but would Saudi Arabia participate, given its various machinations, to reform the alliances across the Middle East to other ones that have really collapsed as a result of this? I'm sure they're a bit pissed, and maybe they would offset the embargo anyway. They have oodles of spare capacity, which is why oil was up in the first place. Before we even got this conflict, they've taken lots of oil off the market. So I'm not sure that you would get agreement between the Saudis and Iran anyway. And if you've got just a partial embargo, then as long as you've got like Saudi on the opposite side of that, then they can probably offset it. In which case that it's unlikely to come about. So I'm not really convinced that we'd see that either. Nonetheless, we've already built a risk premium into the oil price, but that said, although we've jumped up to sort of 90, trading in a range of $90 to $95. I mean, we did get there, 3 or 4 weeks ago anyway, just based upon the supply-demand balance, which was going to be really tight in Q4, with the flow of oil being roughly 3 million barrels short through Q4. So if you factor that in, then have we really rallied at all, the oil price? I mean, I thought oil was already going above $100 before the war even started, or Hamas did anything. So what the war has done is short-circuit a consolidation period for oil after it took a big jump on supply-demand dynamics. But it hasn't gone to new highs at all. And so, you have to ask yourself, Is the war having any impact? And B, what is that? Why is oil not rising quite as much as you would expect? And therefore, is that telling us that global growth is rather troubled, perhaps, or that the oil shortage argument is weaker than it appears on the surface? So various prickly questions and cross currents. What I think we can say is that coming out of the last kind of 4 to 6 weeks of rising oil prices, is that at the moment we got above $90 and certainly approaching 95. We're seeing demand destruction already in the US, a pretty swift response in the United States with consumers pulling back on driving almost immediately. So a very important factor in this, which we'll come back to, will be, how high oil could go if we do end up with more of a risk premium based on some dimension of the conflict, and what that will mean for ultimate prices, given this demand destruction is poised to strike even with oil where it is right now.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show. Back on.
So it's worth noting as well, so within oil, that we've got some quite meaningful amounts of production, though, are also under sanction from a lot of Western countries. So the Russian oil and the Iranian oil are both sort of sanctioned in terms of it being not bought by European countries, or certainly not bought on a primary basis. There's a lot of discussions that just gets refined and shipped off and turned back into these places anyway. But it's sort of a in a way, like they're sort of it's a little bit sort of a nuisance. I guess sanctions that they've got it on. They're not sort of the sanctions about, no, we're going to make sure that absolutely no Russian oil and no Iranian oil sort of ends up in these countries, and we're going to ban companies that are in any way associated. Like there's much harsher sanctions they can put on versus the sanctions that are sort of more a little bit show and that Iran can get around and the Russia can get around, and they sell to the two of the biggest takers of both those is India and China. And so I guess there's a question about if you've got escalation where they got a lot more serious, Western countries got a lot more serious about those oil embargoes, but that doesn't seem to be the case at the moment, without sort of a wider that sort of a wider escalation. And then the question of China's, as Dave mentioned, a client state of both, a client of both Russia and Iran in terms of buying lots of the oil, and China's one of the, I think they're probably the biggest importer of oil now, and so it's certainly not in their best interest for oil prices to be particularly high. But I guess the question is, how much sway do they actually have over sort of these political issues? And my guess is not much. I don't know, Dave, what your thoughts are in terms of China's influence. And
probably not greatly, but enough at the margin to probably give them a little bit of pause.
Yeah. Okay. So that's the politics. Is largely, I guess, that what we're concerned about is wider escalation. I guess the issue with so the big effect does seem to be regional issues in and around Israel don't make much of a difference to the oil price. The Saudis and the Iranians are given they're both sort of using it's a proxy for both. So as long as it doesn't sort of go more direct, then it probably seems to settle down. But as Dave was saying, it does seem as if there's the supply-demand imbalances, which is effectively Saudi Arabia and other OPEC countries taking supply out of the market. That's what's been keeping the prices high. And so then that sort of ends up in two places. So if we're still looking at high inflation, you've either got this idea that the cost push inflation, which is what we've sort of been seeing recently, where it's, yes, inflation's high, therefore workers need to demand higher wage increases, and then that then feeds back into more inflation, and you get that spiral. And the flip side is a case where effectively what higher oil prices do is it takes money. If I have to put $20 more into my car each week, that's $20 that I can't spend on something else, and so that takes away demand from other areas of the economy, and that then leads to sort of demand destruction, and maybe I drive my car less, and things like that. So I might start with the cost push inflation side first. So oil's a very big input into plastics, polyester, a whole bunch, which sort of and they add up in most goods. And then you've got the input cost in terms of transport costs for everything, and so that sort of leads you to oil being a pretty meaningful amount of inflation. So in terms of inflation, we're definitely going to get an impact from high oil prices. Just the pure, here's your energy cost, and that goes up. The question now is the cycle part about how much that will keep cycling through in terms of these other prices. And Dave, so your thoughts on that?
Yeah, well, I mean, the immediate distinction you have to make is between headline and core inflation. Energy is not part of core inflation for this very reason, because it's so volatile.
What Dave's saying about core inflation is that's what central banks are focused on. Is generally it's inflation excluding food and excluding oil, because they're the volatile ones that the interest rates don't really affect.
So you're going to see a rise in headline inflation, most definitely. Market rise, and we're already seeing that. In fact, the last couple of months, as we've kind of run through the oil deflation base effect 2022. So we're definitely going to see inflation rise on the headline basis. Core will take more time, but it would filter through there eventually as well, a little. And I can't help feeling that the moment we get oil, above $100, it's a sort of psychological trigger. That, I do wonder if central banks are going to feel, a little happy, to be honest, than they might have in normal circumstances felt needed to be. Like, we had a number of oil shocks post the GFC that central banks generally just look through, is the terminology, when they'll ignore certain volatile prices. Because they felt the underlying environment was deflationary, and they were quite right. But this time, even core inflation still falling in most jurisdictions and coming down at a reasonable speed. It was the Ukraine war that really put a rocket under inflation in the US last year, and people were still talking, including us, before the Ukraine war, was still talking about temporary inflation coming down relatively quickly without the need for many rate hikes. And, once we got the energy shock coming into what was already a kind of simmering inflationary environment, then very quickly core inflation went nuts. And if I were a central banker, I'd be definitely more anxious about that, a rerun of that being a possibility than I would normally. That would normally be the case. So what does that boil down to? I think it will be sensitive, more sensitive than it would normally be. And the fact that it's not immediately apparent in core inflation, will stay its hand somewhat, but it'll still be looking at headline and being concerned. So it definitely tilts towards making the Fed more hawkish, I think, especially the Fed, because there are potential real economic benefits in the US if shale production starts to respond to the signal of the higher oil price. So I think I would expect the Fed to be more hawkish. Maybe in Australia it'd be more traditional response, where you'd have the RBA, looking through the oil shock as much as it can, because we simply don't have as much of that productive economy left in Australia, where you're going to see cost push inflation, and so it tends to come and go relatively quickly, oil price shocks in Australia. So I'd be thinking that it would be more hawkish for the US than it is Australia.
Yeah. And the other thing to note that we sort of covered off when we ran through the transport sector a couple of weeks ago was that when oil prices go up, the transport sector put their prices up by more than what the oil price actually would justify. So when you see, wherever it is, an airline putting on a fuel surcharge or whatever, it's generally over and above the actual cost of it that's costing the company. And so, if the view is, look, a lot of this is sort of greedflation in terms of companies putting up prices because they can to expand margins, then I guess, the fact that, say, transport companies can turn around and say, well, oil prices are up, so therefore we have to put our prices up by whatever price, regardless of whether that's true or not, is...
I mean, we are still in the tail end of a kind of greedflation environment. So any excuse will do. Well, that would really worry me as a central banker. So,
Yes. So I might just throw up a chart, just interesting in terms of forward pricing. So this is the 5-year forward. So basically, it's saying what's the expectation for inflation from 5 years out to 10 years out is effectively what it is, and it's sort of it's something that you can deconstruct using financial instruments and sort of come up with a price of what's implied in terms of market pricing, and why it's useful. What central banks often use it for is a bit of an indication of what's the market sort of pricing in for inflation, and is the market pricing in problems. And what's then it's backed against the dollars per barrel of oil. And what's interesting is that once you get above $100, or maybe probably more like 110, it actually really the expectations for inflation start to come down. So I guess what I'm saying there is, at higher oil prices, markets are effectively factoring in and saying these prices are too high. They're actually going to destroy demand, and we're going to end up in a situation where your prices are lower. So it's sort of like the
tops out around 105, 110.
Yeah,
it's kind of the pivot. So very interesting, that chart.
Yeah, so that's one side of it. So that's sort of, I guess, an argument for saying, there's sort of limit to how high oil prices can get before they will genuinely start to destroy demand, and it looks like the market's pricing that around about that, as you said, $105, $110. The other thing is there's this idea that which sort of fed into a lot of different analyses of why consumer spending's been so strong, is because we built up these excess savings, or certainly the US consumer did, and a lot of developed countries built up these excess savings in the pandemic, or during the pandemic. And I've got a chart that's sort of showing up of there's been some recent revisions to that. And the idea is that the people's if they're starting from zero in January 2020, they sort of built up an extra sort of $2,500 worth of savings, and partly what they've been doing is running that down over the last year and a half to 2 years, which is why we've seen stronger growth than what we might have seen. Now, depending upon how you cut this, there's a few that try and do it by wealth, and what you find there is that the poorer people have already run out of their savings, and it's actually a lot of this is sort of sitting with the richer people. But regardless of what you take on that, there actually have been some upward revisions that sort of suggest that, look, maybe the consumers do still have a bit of spare firepower and can probably and might be able to withstand the higher oil prices for a little while anyway, and just keep on spending the way they're spending at the moment. So that's one side, which sort of suggests, there is demand destruction, but maybe there's a little bit of extra that can carry us through that period. The other one I just wanted to talk about was the electric vehicle side. So the idea on here is obviously that the higher oil prices get, the more economic it becomes to switch to electric vehicles, which then takes away demand from oil, and the demand that it takes is probably gone forever. It's not once you've decided to buy an EV, and if oil prices fall, you're unlikely to then just go and sell that EV just to go back and buy yourself a petrol car. So I've just got a couple of different charts I'm running on here, which is just comparing if you buy an electric vehicle, how big does the battery sorry, let me start again. The main calculation you need to do in terms of the economics of an electric vehicle is saying, well, how much extra do I need to pay for this battery? And then compare that to how much cheaper my petrol and servicing costs are going to be, and then try and work out a payback on that. And the issue is that if you, most people don't drive that far, so most people drive sort of, say 10,000 or a little bit more kilometres per year, which is sort of 200 kilometres per week. And so, if you only had a battery that would take you 100 kilometres, then that'd be no problems at all, really. It's more about the range anxiety and how much people actually genuinely want to buy before they're comfortable. And so, if you had a smallish battery, so if you were happy to have, say, 100 kilometre range battery, then at $100 oil, your payback, and this is in the US, so it varies between countries, your payback is like 1.5 to 2 years. But realistically, that's not, people do want more than that. So then if you look at, say, an 800 kilometre or a 500 mile range, now you're talking about payback of over 8 years. And so, and that's sort of the top line and the bottom line in those graphs. And so, there's this question in the US about, well, how much higher does, every time the oil price goes higher, it just makes electric vehicles that much more palatable. Now, the second thing you really want to focus is how much you're driving every year. So for commercial vehicles, they're already into the phase. If you're driving more than, say, 50,000 kilometres a year, it's already got to the stage where the paybacks are low enough that, and you can obviously recharge on a regular basis. The paybacks are already, it's already significantly advantaged to that. So I guess what I'm trying to show here, though, is that, let's say we took the 300 kilometre battery, is that if your payback's about 4 years at $100 of oil, if it goes to 150, you get back to 2.5 years. And I sort of feel like the range of about 3 years is probably where you start to get some real crossover and people start doing this on an economic basis. So we're not there yet, but you'd still need oil prices to go a fair bit higher. The thing to note, though, as well, is that's the US where oil's quite cheap and electricity is quite cheap as well. When you start looking at different countries, it all starts, the equation gets a bit more mixed up. So in Europe, you've got a lot more diversity as well, but basically both fuel and electricity are much more expensive in Europe, but the distance they travel every year is very low as well. And so it looks much worse for Europe in terms of higher oil prices. Oil prices would have to go significantly higher, sort of $200 before you start saying, on an economic basis, this is worth switching at current sort of prices. Having said that, there's lots of subsidies in Europe. So, pick your country. If you get a big subsidy, then obviously that'll shift all these curves back significantly. And then Australia actually looks pretty similar to Europe in terms of our electricity is pretty expensive. Our petrol is cheaper than Europe. But so what that ends up meaning is that you've got cheaper petrol than Europe, so that makes it more attractive to own a petrol car in Australia. And then electricity is much more expensive than the US and more on par with what you'd see in Europe. And so, if you're charging from a solar panel, then it absolutely makes sense because your costs come down dramatically. But based on the cost of charging this from infrastructure, the paybacks in Australia actually don't look that particularly attractive. And so I guess what I'm trying to get to there is, higher oil prices, yes, there's going to be demand destruction from more EVs coming on, and it's going to accelerate it. You're probably going to see China, I think, in particular, which has already got some significant penetration in terms of electric vehicles and a massive price war going on there. This is just going to spur them to do more of it. And so the short-term fundamentals of a higher oil price effectively just mean you're going to shift a number of countries just to electric vehicles earlier than what you might have done if the oil price stayed low. So it's sort of a good short-term effect, but actually quite a negative longer-term effect.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now, direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defence contractors. You can find out more at nucleuswealth.com. Now back to the show. Just one more quick thing. We just want to ask you for a simple favour. We want to spread the message about transparency, innovation, and integrity in investing. At Nucleus Wealth, we live and breathe these values. We would love it if you can help us spread that message, and subscribing to our channel will help us do that. We would be most grateful if you can hit the like and subscribe button now. Now we have our question of the week. So this is for viewers to have some discussion in the comment section over the coming days. So the question for this week is, will oil destroy demand and lower inflation, or fuel cost push inflation? So feel free to post your thoughts and engage with us and some of the other viewers over the coming days. We've just had a couple of comments coming through, one from BB. He's saying, yes, oil is going to fuel the flames of inflation. And he's also saying, thanks for the discussion, guys. He's positioned for rates higher for longer, given energy and inflation. And he's thinking debt is going to be toxic very soon, in his humble opinion, he says. Over to you, Dave, for the investment implications.
Sure. So, I mean, as I said, it's a bit paradoxical because oil was already rising, and so what looks like a shock coming out of the war isn't really a shock. It was going there anyway, and the immediate implication is interest rates, and therefore the bond market is the first sort of topic of discussion. Now, we were seeing rising yields with oil, especially at the long end of the curve. So, building out higher interest rates for longer tenure bonds. And, we're continuing to do that now. Now, there was a period in between where there was a lot of uncertainty in the market and yields fell, pretty sharply on a safe haven trade into bonds when the war first came about. So, bonds are a really interesting question at this point. If we have no escalation in the conflict and this ongoing bubbling oil price without going crazy, maybe topping out around $100, then I think yields go higher, and so that's quite negative for growth pretty much everywhere relatively quickly. We would definitely start to be thinking about, what's going to break in markets if that's the case. And, there are a few things that present themselves. as I said, we'd been seeing these rising oil and yields for a number of months before the conflict, and we were, it's already becoming apparent that US bank lending is starting to be squeezed by it, especially smaller banks, because they hold a lot of bonds for liquidity purposes, and so when they all sell off, they have these paper losses, and it promotes balance sheet restructuring for them, and part of that will be less lending and higher standards. And so I'd be looking at the space where Silicon Valley Bank went bust as a possible evolution of the shock. And conversely, if we do get an oil embargo of some sort, or the price really goes nuts, I actually think, and based on a regional conflict, then I think bonds are probably bid again, and so it's a safe haven bid. Even though oil goes through the roof, I think immediately bond yields would start to come down, and equities would probably come down as well. In fact, almost certainly they would. And at that point, if you were talking about oil up around 120 or even 150 on some kind of escalation, then I think you're looking at an end of cycle shock, basically, as that lands on the consumer worldwide. And rather than see an inflationary shock, I think we'd actually see a deflationary impact in most markets almost immediately, which is the chart that Damo was showing us earlier. When oil gets anywhere near above $100, you get that counter-cyclical reaction in markets really quickly. And I think if you added the fact that you had a regional war going on in the Middle East, then you would have quite a strong bid into bonds relatively quickly. So bonds are a really interesting pivot on how the conflict evolves here. On both counts, though, relatively contained conflict with a higher oil price and escalating conflict with a much higher oil price, you kind of end up in the same spot before very long, and that is at some end of cycle event relatively quickly. And so, I'd be looking to buy bonds that were selling off into this event as one instance of how to play that. And of course, that has immediate implications for Forex and stocks. In terms of Forex, I think it's all pretty US dollar bullish, both in terms of safe haven play, Federal Reserve, and rising yields as well in terms of selling bonds and treasuries. All of that is pretty US dollar bullish. So I think, likelihood is we see another leg higher in the US dollar before we get to, whatever kind of outcome this is going to deliver for us globally. And therefore, probability is another leg lower in the Australian dollar. Is probable, given risk, as it were, will be off. And that brings me to equities. I mean, there's been a reasonably strong correlation. The moment oil gets up around $90 again, that equities really start to struggle as the yields rise. I've seen that consistently over the last kind of 6 weeks or so. And so we're seeing a downtrend forming in equity prices as this process plays out. And I think equities are an interesting possibility for for whatever it is that is going to break as well to kind of get us to this lower inflation environment. I think equities are a candidate for a large enough sell-off to really deliver a blow to especially the US consumer. So possibility there, but even if not, if they hang on, then I think equities are, based on both price and earnings, are going to need to be discounted as we go through this, and then within equities, the likelihood is you're going to see the duration stocks, that is growth, Nasdaq, tech, etc., hit harder than the wider market because in particular that. Growth has a strong beta to yields in terms of the multiple that you will ascribe to growth and how long you're prepared to wait for earnings to come through on that growth. So So any equity downside is likely to be, intensified in duration components of the equity market. And I mean, on top of that, you might see some late cycle winners if it doesn't get too bad, oil, miners, etc. But I think we're so late in the cycle now that's if that were to eventuate, that's a selling opportunity, and it's probably not likely to eventuate anyway because oil's so close to demand destruction already, and we've got many, many other headwinds coming to bear on the cycle simultaneously. So that's about the wrap for me. Damien, you want to add anything?
Nope, I think that sounds good.
Nice one, guys. I just want to add as well for the viewers, the views shared in the podcast are reflected in the Nucleus Wealth portfolios. And also, you would have heard in the sales promo video, we do have around 100 different screens and tilts. And just want to give some ideas of these topics, how you can play these across all the Nucleus Wealth portfolios. So you'll see on the screen, one of the tilts there is climate change. So you can exclude all fossil fuels or worst offenders if that's what you believe or you wish. With energy, you can exclude the GIC sector energy. With the tilts, you can include GIC sector energy if you think oil price is going to go higher. And again, we've got another screen for war. So if you want to exclude any company that is involved with arms manufacturing, you can exclude those as well. So lots of different scenarios you can play and choose from in there. So jump into the Nucleus Wealth onboarding portal. It's a no obligation onboarding portal. Get started button on the top right of the website, and you can have a play around with some different scenarios in there. So that almost wraps us up for today. So Dave and Damo, thank you for sharing your views, and I'm sure we're going to continue to talk about this over the coming weeks as the conflict unfolds.
Thanks for having me, Zach.
Pleasure. So we do welcome your feedback on this podcast, especially in regards to suggestions for future topics. If you do have any ideas, please drop it in the comment section below or send us an email to contact@nucleuswealth.com. Also, if you know of anyone that might get some value out of today's episode, we'd really appreciate it if you do share it with them. So for myself, Damien, Dave, and the rest of the team at Nucleus Wealth, thanks for watching, and we look forward to seeing you next time. Bye for now.